Hello guys, welcome again to another quick lesson. In this one, I'm going to do again the loan adjustment, and remember this is an extract from the NSC November for the year 2021 now. All right, so in this question paper, they were doing the correct net profit after tax calculation. As you can see here, it's a correct net profit after tax calculation and the statement of financial position, which is here, statement of financial position. So they were given a loan adjustment as well. Let's see how this loan adjustment could have been done. Okay, so I'm no longer going to open a T account because now you have an idea of how to do the loan account. Let's quickly cut corners and do the fast approach. So we are told the repayments on the loan are fixed at 35,000 per month. Fixed at 35,000 per month. This already is telling us about the short-term loan. They're already saying when you make payments for this year, you must have the next financial year in mind because your repayments are fixed at a particular amount. Okay. And then we are given the balances and provide for interest on loan. And then G then says a fixed monthly installment of 35,000 to cover loan repayments and interest has to be paid over the full period of the loan. Interest will decline over the loan. The interest on the loan is budgeted for the next financial year is 234. Okay, we're going to come back to that. So the first thing is we need the interest on loan, which will be shown in the correct net profit after tax calculation. And for us to do that, we are now going to say, if we are paying 35,000, if we're paying 35,000 per month, and we know we have a year, so let's come here, we're going to say the 35,000, then we multiply that by 12. That simply means the loan total payments is 420. Okay, so the total payments, including interest, is 420,000. Total payments. All right, so let me bring it here. Total payments, my total payments are 420,000. But I know that when I make total payments, I'm paying for two things. All right, number one, I'm paying for the loan. I'm paying for the loan. Okay, the capital portion of the loan. And to get the capital portion of the loan, you can simply get it by getting the difference between the balances on 1 July, which is 4,125,000, and the balance on 30 June, which is 4,028,000. So the difference between these two tells me about my capital portion of the loan that has already been repaid. Let's see if we can do that one. So I'll now say my 4,175,000 minus the 4,028,000. That will give me 147,000. So it means the amount that we have paid on the loan this year is 147,000. This is the loan repayment for this year. So capital portion repayment of the loan, it's 147,000. But if I have made total payments of the loan of 420, that means the second amount therefore becomes my interest. All right, so the difference between those two will therefore give me my interest. Okay, so it will be my 420, okay, which is the total payments, subtract the loan repayment, which is 147,000, and then it would then give me my interest, which is 273,000. That would have been the fastest way to get this interest on loan. So to get the interest on loan, I would therefore come here and I would open my bracket and I would say the 420, I would say 420,000, and then I subtract my 147, which is the capital portion of the loan, and then I remain with 273,000. Remember, this is interest on loan. Therefore, it will decrease my net profit before tax. So I must put it in bracket. It must be in bracket. Okay, now let's come here now. Remember, there's several ways in which one could have done this adjustment. Several, so many ways in which you could have done this one. The next one is on the non-current liabilities and the current liabilities. Okay, so we are told now that the monthly installments will be fixed, all right, and it will be paid for the full period of the loan. Interest will then decline. What is going to change is the interest over the life of the loan. The interest on the loan budgeted for the next financial year becomes 234. Remember, it was 273. Now they're saying it's going to decrease and it will become 234. So when I come here now, I'm now saying on my loan, I can either take this one. Okay, let me take that one first. If I take the one in information A, which is 3,755,000, I know that that amount has not yet been provided for interest, because interest still needs to be capitalized. So that's why you see here they say provide for interest on loan. So if I take that 3,755,000, I must still come and add the interest on the loan, which is 273,000. Okay, and I want to show you something. So if you do that, which is your 3,755,000, and then you add the 273,000, it will give you already the amount that we're given here, which is the 4,028,000, which is per the statement, because on the statement, interest would have been provided for already. So I might as well just come down here and use the 4 million. Okay, let me use a different color pen. I might as well just use the 4,028,000. 4,028,000. It's still the same thing as me taking the 3,755,000 and adding the interest. Now, the important aspect, therefore, is on the short-term loan. We are then told that of the total payments that we're going to be making next year, remember how much are we going to be making next year? We are still going to make payments of 420 here. We're still going to be making payments of 420. It's fixed. But we now know that the interest is going to change. The interest is now going to be 234. So interest is now 234, like that here. So the question then is, how much is the loan? So I'll come here and I'll now say the 420,000, then I subtract the 234,000, okay? And then it will